Hello, it's me again. In this video, we are looking at retirement funds. As you will recall, we've already looked at tax-free investments. Now, retirement funds or retirement savings vehicles are the other broad category of tax-effective long-term savings. So let's quickly run through the types of retirement funds that we're going to have a look at. They are all have similarities, but they also have some differences, as we will show you. We have a pension fund, which is linked to your employment. Provident fund is also linked to your employment, but it's very similar to a pension fund, but I will explain the differences. Then there's a retirement annuity, which is not linked to your employment, which you can set up yourself. And then there's a preservation fund, which is for if your employment status changes, so you leave your employers, and your pension fund or provident fund therefore needs to be withdrawn. So let's look at these in more detail now. Before doing so, I first want to quickly explain what an annuity is. You may have heard the term before in this course. Now you're finally being showed what it means. An annuity is a periodic repetitive payment, which is usually annual or monthly, and it's owed to a person until their death or the happening of some other event. So you could pay a lump sum of money to a long-term insurer, often like Sanlam, and then they will pay you a monthly amount as an annuity until you die, for instance. And you may remember that annuities are specific inclusions in terms of the Income Tax Act, meaning that even if they do not fall under the definition of gross income, they are still to be included in your taxable income. So now let's look at what a pension fund is. Firstly, it is for people who are employed, and as an employee and your employer will usually both contribute to your pension fund. The employee's contributions are tax deductible for the employee, and the employer's contributions are tax exempt, meaning that even though they might fall under the definition of gross income for the employee does not have to pay tax on those contributions. A pension fund is managed by a fund manager who has the discretion as to which assets to invest in, and these fund managers have to be licensed, and they are also limited by regulations as to what they can and can't invest in. They can't invest too much in risky assets and so on, as well as offshore assets, which are also limited. When you retire, you can receive up to 1/3 of your pension as a cash lump sum, which is taxable at specified rates, and then the balance, which you do not withdraw, is used to purchase an annuity, and then that annuity will pay you a monthly income during your retirement years. The income that you receive from the annuity is taxed just like any other income, because it is a specific inclusion. It gets included in your taxable income, and it's subject to normal income tax. Then we have a provident fund, which, as I mentioned in the introduction, is similar to a pension fund. Actually, it's almost exactly the same. It's also for people who are employed. In terms of the rules, it's very similar. Since last year, or March 2021, when they made some amendments to the relevant legislation, provident funds are almost exactly the same as pension funds now. The only big difference is that a pension fund is a larger institution that offers services to various employers, while a provident fund is often set up by a single company or maybe a few companies, and they are set up for their employees. That gives those companies who've set up the provident fund more say as to which investment decisions the fund manager makes, or they appoint the fund manager themselves. So that's the major difference between a pension fund and provident fund. but from a tax perspective, they are taxed almost the same. Then we have a preservation fund, which is for if your employment status changes, because provident funds and pension funds are linked to your employment status. If you lose your job, your pension fund must go somewhere. So it goes to a preservation fund or a retirement annuity, which we'll get to shortly. And likewise, a provident fund will go to a preservation fund or a retirement annuity. There are no tax consequences to transfer your pension or provident funds to a preservation fund. And the same rules as pension and provident funds apply with regards to tax. Then, a retirement annuity is a bit different from the previous three, as it's more flexible and is not linked to your employment status. You are also able to decide where to invest the funds, unlike with your pension or provident fund, which is decided on by a fund manager. There's also legislation limiting the types of investments that can be advertised as retirement annuities, but it certainly is more flexible and provides a holder of a retirement annuity with a lot of, or leaves it to your own discretion really, with regards to how risky you want your investment to be. Contributions to retirement annuities are tax deductible, just like contributions to other types of retirement savings, as I've mentioned. And the rules with regard to tax are also similar. So now we're looking at the rules that are applicable to all retirement funds. Okay, scrap that. Start again. So now we are looking at the rules that are applicable to all retirement funds. You may only realize your pension or provident fund or retirement annuity when you retire after the age of 55, or due to ill health, or if you emigrate. You may also access your pension or provident fund if you lose your job, but you're going to be taxed at a higher rate if you do so. When you retire, you may withdraw up to 1/3 of your pension benefits as a lump sum, which is taxable at specified rates, which you can access in the study materials. The remaining balance must be used to purchase an annuity, which then pays you an income until you pass away. You may withdraw up to 1/3 in cash before retirement in some cases, but you will get taxed at a higher rate if you do. A benefit of all these retirement savings that we've looked at in this video is that it's protected from your creditors, meaning that if you are in debt and your creditors are trying to attach your assets, they cannot attach your retirement savings. Or if you were to be declared insolvent, if you're bankrupt, then even in those circumstances, your pension savings are protected. Another benefit is that your pension savings are exempt from estate duty. So now we have gone through the types of retirement funds. There's the pension fund, to summarize, is linked to your employment, but it's a larger fund managed by a fund manager. There's a provident fund, which is similar to a pension fund, but it's set up by companies or groups of companies for their employees. Then there's a retirement annuity, which provides you with more flexibility. You yourself can set it up and it's not linked to your employment. And then lastly, there's a preservation fund, which is where you can transfer your provident or pension fund without tax implications if you were to lose your job. So those are retirement funds. In the next video, we are going to compare retirement funds and tax-free investments. I'll see you there.